Welcome back to Reflections in Real Talk. I'm Judy, and today we're diving into something that every soon-to-be retiree worries about. What happens if the market crashes right after you retire? And if you've ever found yourself staring at the headlines and wondering whether it's safe to retire, this episode is for you. Before we start, make sure to check out my link below to try Bolden, the all-in-one financial planning platform I'm using in this episode. You can explore your own retirement scenarios using my affiliate link in the description. Meet Brad. He's 63, and if you've been following this series, you might remember him from our Roth Conversion Explorer episode. Back then, he was fine-tuning his tax strategy, figuring out how to convert part of his traditional IRA into a Roth to lower his future taxes. But today, Brad's facing a whole different kind of worry. He's been seeing all these headlines about how the stock market has been too good for too long and how a crash is just around the corner. Markets overvalued. Is the crash around the corner? Experts warn, storm ahead. So now Brad's asking himself, should I retire now or wait another year and hope things settle down? That's when Brad uses Boldin's Market Risk Explorer to find out what would actually happen in his retirement plan if those headlines turned out to be true. Boldin's Market Risk Explorer is a tool designed to model different downturns and test your plan's resilience. It's all about answering one big question: how much market pain can my retirement plan handle before my lifestyle is at risk? And this is why testing for downturns is so important. Market downturns, especially early in retirement, can dramatically affect your ability to sustain withdrawals and meet long-term goals. By modeling downturn scenarios, you can identify weak spots early and build strategies like extra cash reserves or flexible withdrawal rate. And now for the on-screen demo. Welcome back to Bolden. As you can see here, when you first log in, you're going to see your account settings page. I just want to pause here for a moment. In addition to looking at your profile, you do have an opportunity here to add a spouse. So if you've already entered all of your information, you can certainly do that here. And I've had a couple questions in the comments about that, and this is where you could certainly do it. Now let's X out of that. And this brings us right back to our overview page. Here we have Brad. His current net worth is $1.23 million, and his projected net worth at retirement is $1.26, and then at longevity, $5.9 million. I did want to point out that his longevity is projected to be 100. We can certainly change that to 90 or 80 or what have you. I'll show you how to do that later. I just want to point that out, that I've had a lot of comments, that's unrealistic. Well, maybe it's optimistic, but better safe than sorry, right? And then if you hover over here, you'll see that his savings break down. He's got $1.16 million in his retirement accounts. He's got a home valued at $500,000, and he does have a mortgage on that. So his total net worth is 1.16, and that's how that's calculated. And then again at longevity, if you hover over this, that's how it breaks down. This is calculated in current dollars. You can also change that to future dollars. His retirement chance of success is 99. And this is stating that you have a 99% chance of fully funding your plan through longevity. That's not the same thing as being able to meet your monthly expenditures. And that's where the Market Risk Explorer is really going to come in handy, and making sure that we have enough money to fund those monthly expenditures. And if not, how can we make some changes so that we can achieve success? Not just the success at longevity, but our monthly and annual expenditures. So it's always a good idea to start out and making sure we're in the right scenario. Here we have two scenarios. We've got our baseline and Roth conversions, and I'm going to go to the scenario manager and just select our baseline here. Let's look at that and review the summary. And this is just a free text note, so you want to make sure that everything that you've typed in here is accurate. We've got no Roth conversions, current age is 63, retiring at the end of this year. His investment total is about $1.23 million, with $550 in his pre-tax accounts, which is the 401k, $450 in his Roth accounts, and taxable savings $120,000. And then he intends to collect Social Security at age 65, and he expects to receive around $3,200 a month. And it does calculate in the cost of living increase as well, which is a nice feature of Bolden. Again, we have his planned longevity age at 100 and filing status is single. And then he is going to start out with that 4% rule, which puts him at just under $50,000 per year that he needs to fund his retirement expenses. And those numbers that I have are nice and round for demonstration purposes. Of course, your numbers are going to be a little bit different, but this is really just an overview of the features and how you can model them for yourself. So to make sure you're in the right scenario, click on that arrow, and now we know we're in the right scenario. Let's look at these numbers again here. His current net worth is 1.23 at retirement. He's got 1.26. His longevity is 100 and he ends up with 5.2 million at the end. Here you can see how that plays out. His house is paid off and he does own that asset, and it's in current dollars as well. Let's look at a couple of the features that play into these assumptions here. I'm going to click on my plan and let's just review his accounts and assets here. He's got his Roth IRA with a moderate rate of return of 8.08. His traditional IRA, also moderate rate of return, 8.08, 550. He's still working, so I've got some of those modeled in there. And then he's got his emergency savings and money markets at 120,000 with a rate of return of 3.5%, and a savings account. He's got a little bit of emergency money in there, just 2% rate of return on that. Now let's look at his home and real estate. He's got that primary mortgage here. 500,000. He owes 400,000. He pays 2,500 a month, and 4.75 is his APR, and he lives in Texas. So it calculates his estimated payoff date of October 2046. And you can use Bolden to model early payoffs, which is really lovely. And then because I've got his zip code in here, it's going to model the state taxes for him as well. It's another nice feature. And then looking at his expenses in healthcare, there's two ways to model these expenses, and I won't go into detail because I did a whole video on that. But here, let's just look at his nice to spend and have to spend and make sure it's realistic. So he's got his mortgage, $2,500, that's calculated in the home expenses. Property taxes of $6,000 a year, some utilities and communication services, automotive expenses, and then when it comes to food and dining, he's got some must spend and like to spend, so that gives him a little bit of a buffer in there when he needs to cut back on his expenses. Some personal care items are also optional, luxury items, and of course vacation trips and so forth. Those are also like to spend. So here you can see those summarized up there. He's got a must spend of around $42.35, so let's just call it $4,000, and like to spend a little over $5,000, $55, and so that kind of gives us our benchmark for how much Brad needs every single month to live on. We'll just call it $50,000 and $60,000. So since our numbers are round, it's pretty easy to calculate. Now let's go into income. Again, he's still working, but just till the end of the year, so it's not too significant. And then Social Security, and here's where you would change the Social Security claiming age. So we've got him claiming at 65. It does give us a nice warning that he's getting a 13% reduction. And we can play with those numbers and we can see what happens if he claims at 67, which is full retirement age for him, or 70. And while we're on this page, I just want to show you, because this is without the Roth conversions, those RMDs are pretty high. We've got 54,000 all the way up to 76,000 using this scenario. Now that we've checked all of our assumptions, we can look at the Market Risk Explorer. We can see how our savings hold up in a market downturn. What if you experience a market downturn or a sequence of poor returns around your retirement date? See whether your portfolio will sustain withdrawals to meet your financial goals, and why does this matter? So you can read that here. Also wanted to highlight the common ways to reduce the risk. So as we go through these and you see that he's going to have some challenging years, what can he do? He can increase his cash reserves. He can use a flexible withdrawal strategy. He can ensure that asset allocations matches his risk tolerance. Of course, he's still working, so he could potentially continue to work a couple more years. He could also work part-time. So there's a lot of different things that you can do to mitigate these risks. And let's look at the first model here. This simulates a decade of weak market performance starting the year you retire, 10 years of modest investment returns, which is plus 1% annually, which reflects the impact of periods like the early 2000s on your retirement portfolio. The next scenario, which is built in, is the sequence of return risks, which simulates multiple years of bad returns early in retirement. 3 consecutive years of varying negative investment returns starting at minus 15%, which reflects how timing of returns, especially during early retirement when you're drawing down your investment, impacts your retirement. And the last scenario is setting your own assumptions for when the market drops, how long it lasts, and how severe it is, ideal if you have a specific scenario you want to test. And before you click on any of these buttons, there's a couple things you want to check on this page. Number one is the account selection area here on the left side of the screen. You can see that Bolden has automatically selected the 2 retirement accounts and excluded the 3 cash accounts, checking, savings, and money markets. And that's because they perform differently with market fluctuations. But you can always select that if you'd like. But here we're going to use the default. And then the other thing I want to show is that this is also displayed in today's market dollars. That's the calendar with the check mark. You can also select the crystal ball icon, that's future dollars. And I'd love to hear in the comments what you think is the most appropriate way to model these. And I have my own opinions, but I'd love to hear it from the viewers. Okay, so now we've got the decade of poor returns, and you can see here that the market downturn starts right here in 2025. He's got 1.16 in savings, but with the new market projections, only 1.15 and 1.1 the following year, 1.07, 1.04, 1.01, and now just under $1 million in year 2030, and it's going to go down all the way to 2035 to 802,000. So he is going to struggle meeting those monthly expenses, despite the fact that he's got a 99% chance of success. Remember what that means is that just means he's going to have money in his accounts at longevity. It doesn't mean he's going to have the ability to meet his monthly expenditure. So he's going to have to be a little bit more flexible in his withdrawal strategy and have a little cash to rely on during those market downturns. So that's one scenario. Now let's click on the 3-year sequence of return risk. And this is a little bit more severe for him as well. If he continues to withdraw from those accounts while those values are down, it's going to really impact his portfolio and ability to meet his monthly expenditures. Here he's dropping below the 1 million mark in year 2 already, 772. Let's see how low it goes, 652, and then it starts to trend back up. But he's really going to have a hard time meeting his monthly expenditures here, and this highlights that and gives him the information he needs to come up with some new strategies to make sure that he can weather these financial fluctuations. At the end of longevity, he's got 2.19 million as opposed to 4.7. And you can go back and change it to the Roth conversions just as easily and see how that plays out. So let's just click on this one. So we've got $754,000 in year 2035 without the Roth conversions. And at longevity, he's got 2.19, and that's with no Roth. Now let's go back over here, change it to the Roth scenario. Going back to the Market Risk Explorer, we've got the 3-year sequence of return risk here. Remember, we started with 1.15. It's already down to 1.14. And then we were looking at the 2035 number. So he had 754. Now he's got 763. So those Roth conversions have already paid off. And then in the end, he's got 2.66 versus 2.19. By 2035 and at longevity, the Roth conversions have benefited him in terms of his net worth. And then you can also do the market downturns if you'd like. I'll just click on that to show you what you can do. I'm not going to play those all out, but you can change the year that they hit. So we can set it to 65. You can indicate how long the downturn lasts, 1 through 10 years, and you can customize the percentage that the investments drop as well. A couple other things on this page I'd just like to show the help. If you'd like to click on that, you can see that there's a nice article here on the new feature written by Michael Pappas about a month ago, and it describes the Market Risk Explorer. They have their own video and describes the 3 different scenarios. And the technical details, just wanted to highlight this for a moment. If the primary user is already retired, the downturn simulation begins 1 year from the current month. If the primary user is not yet retired, the downturn simulation begins at retirement age. So that's important to note. And the Market Risk Explorer does not apply standard deviation assumptions during the fixed downturn simulations. After the downturn simulation concludes, the rate of return align with the rates of return align with the user's initial assumptions, as there's no program market recovery. So just keep that in mind. It is an algorithm. It does calculate it for you. It's a great stress test, but there are many different simulations out there, so it's important to know how they work. All right, well, let's see a couple different variables that I know everybody's thinking about. What happens if we change his longevity age? And what happens if we change his Social Security claiming age? So let's just look at two things here. Let's look at what we have in the year 2035. So we've got $763,000 in 2035, and we have 2.66 million at longevity age in the year 2062. Now, without even changing the longevity age, I just want to point out that if we were to change that longevity age to 90, that would be the year 2052. So that's going to be 1.66 million at longevity age, and nothing else is going to change. So we really don't even have to go into the system to do that, but I'll show you how you would do it anyway. So you would go back up here and you'd go into My Plan Summary, and here's the longevity age, and you could just change that to 90, and then go back into the Explorers menu, into Market Risk Explorer, and again it's 2052 and it's 1.66, so exactly what I said. But I don't want to change too many variables at once, so let's go ahead and change the longevity age back to 100. Let's leave everything the same. We've got the longevity back to 100, and then let's change his Social Security claiming age. I know a lot of the models want you to claim as late as possible so you get the maximum amount. So let's go ahead and change that to 70 and see how that impacts his plan overall. Save that. Remember, he had 2.66. Now he's got 2.61. So he's actually got a little bit less money. And what about 2035? He had 763 and he's got 596. So for him, it's better to claim at 65. All right. So that's Boldin's Market Risk Explorer. Let me know if you have any more questions in the comments. So how likely are these scenarios? Let's take a quick reality check. How often do markets actually behave like this? History shows us that downturns happen regularly and they don't last forever. The Great Depression saw an 85 to 90% market decline over 3 to 4 years. The 1973 to 74 recession, markets fell around 45 to 50%. The dot-com crash, 49% drop over 2.5 years. The 2008 financial crisis, 57% drop lasting 17 months. And even the COVID crash in 2020, a 30 to 35% drop, recovered in just 5 months. So yes, downturns are part of investing, but they've always been followed by recoveries. The key isn't timing the market, it's building a plan that can survive its cycles. Let's look at the facts behind some of the headlines today. What the Shiller CAPE is telling us right now. Things look a little stretched. The U.S. stock market is near record highs, and one long-term metric, the Shiller CAPE ratio, is flashing caution. The CAPE smooths earnings out over 10 years, adjusting for inflation and economic cycles, and today it's sitting around 39 to 40, close to the levels we saw before the dot-com crash. That doesn't mean a crash is imminent, but it does mean investors should temper expectations. Use realistic return assumptions with valuations. With valuations high, plan to 4 to 5% returns, not 7 to 8%. Stay flexible with spending. Adjust withdrawals when markets fall, using Bolden's expense guardrails. Stick to the plan. Don't let the headlines drive decisions. Planning and discipline beat panic every time. Expense flexibility with Bolden's guardrails. Now let's talk about expenses, because flexibility is one of your biggest superpowers in retirement. Bolden lets you create a detailed budget with must-spend and like-to-spend categories. In a market downturn, this becomes your lever that you can dial back the like-to-spend areas temporarily, such as travel or dining out, while protecting essentials. These guardrails help keep your withdrawal rate sustainable and can boost your plan's success rate dramatically, even during rough markets. That's how Brad ends his session, confident, informed, and ready to retire without fear. So what did we learn from Brad's story today? The market will always rise and fall, but planning helps you ride through both. Tools like Boldin's Market Risk Explorer lets you model real-world scenarios before they happen And being flexible with spending, not fearful, is what turns a fragile plan into a resilient one. If you'd like to try Bolden for yourself, click my affiliate link below and explore your own retirement story. And let me know in the comments, what other Bolden features do you want to see next? Maybe we'll dive into debt paydown strategies next. Until then, keep reflecting, keep planning, and I'll see you in the next episode of Reflections and Real Talk.